Okay, so if I were to ask you to close your eyes for a second and picture the single most influential entity in the global economy, say over the last 20 years.
That's a big question.
It is, right. But I don't mean a specific person, not an Elon Musk or Steve Jobs, and not an app on your phone. I mean the actual engine room, the machine behind the scenes. What image comes to your mind?
Well, I think for most people, the immediate image is probably a trading floor in New York, Wall Street.
Right.
Or maybe a huge server farm humming away somewhere in the desert.
Right, or maybe the boardrooms of a central bank, setting interest rates.
Exactly. Something institutional, something massive and, I guess, old.
But what's so fascinating, the reason we're doing this deep dive, is that if you actually look at the data, if you look at the sort of source code of how modern life has been re-engineered, the answer isn't a bank. It isn't a government.
No.
It's an organization that started basically as a summer project. It's just 2 letters, Y and C.
Y Combinator.
Exactly. And look, I know everyone listening has probably seen the name. You've seen that bright orange Y logo on Twitter, or you've heard it dropped in conversation at a coffee shop.
Oh, yeah, for sure. It's part of the lexicon now.
But the reason we're digging in today is because I honestly don't think people fully grasp the sheer scale of the impact here. We are not just talking about some exclusive club for coders.
No, not at all. We are talking about an entity that is the engine behind over 5,000 companies.
5,000?
And to put a really concrete number on that impact, if you look at the combined valuation of those companies, as of the latest data we have, which is coming into 2025, it is sitting at $600 billion.
600
Yeah.
billion dollars. That's just a staggering number. I mean, that is larger than the GDP of many, many countries.
It is. It's a nation state level valuation.
And it was generated essentially from scratch starting just 2005.
And what makes that number even more impressive, I think, is the breadth of it. We aren't just talking about, obscure enterprise software that nobody's ever heard of, although they have plenty of that too.
Right.
We're talking about brands that have become verbs. They're woven into our daily lives.
Let's just run down a quick list, because it's basically a greatest hits of the internet age. You have Airbnb.
Which completely revolutionized the hospitality industry and how we think about travel.
Totally. Then you've got Coinbase.
Which, for better or worse, brought cryptocurrency into the mainstream conversation. It was the front door for millions of people.
And DoorDash and Instacart.
Yeah, which fundamentally changed the logistics of food and grocery delivery, especially during the pandemic. That was a lifeline.
It was. Then you have Dropbox, Reddit, Stripe, Twitch. I mean, just stop on Stripe for a second. Stripe alone powers a huge percentage of all internet commerce.
It's the plumbing. If Stripe goes down, a big chunk of the online economy just stops.
And Reddit is the front page of the internet. So this isn't just a portfolio of companies. It's like the infrastructure of the modern digital economy.
It really is. I saw a thought experiment once that said if you woke up tomorrow and every single YC company was just gone,
Yeah.
the internet as we know it would fundamentally break. A lot of it just wouldn't work.
So that is our mission for this deep dive. We're going to move beyond the buzzwords. We're going to try to ignore the valuation hype and the celebrity founder worship for a bit.
Mm-hmm.
And we're going to try to understand the machine itself. How does a firm that started in 2005 basically industrialize the concept of startup success? We want to unpack the mechanism.
We're going to look at their deal, how the money actually works, the fine print that every single founder signs. We're going to walk through the fascinating evolution of their leadership from the founders to the big expansion era and then back again.
And this is important. We're also going to look at the experiments that didn't work, the glitches, the failed expansions, because I think those failures tell us just as much about their philosophy as the huge successes do.
Oh, for sure. The pivots and the dead ends are where you learn the most.
And for all this, we've got a great set of source materials. We're working off a really comprehensive historical and operational overview of the company, and it tracks the timeline right from the founding days in March 2005 all the way up to the present-day restructuring.
So we have the full arc of the story.
We do. So let's rewind the clock. It's March 2005. The dot-com bubble burst a few years ago. The tech world is actually kind of quiet.
Yeah, it's not the booming gold rush atmosphere we think of today. Capital had really dried up. It was a tough time to raise money.
And into that environment, Y Combinator is born. So who are the architects of this thing? Who's in the room at the beginning?
So you have a founding team of 4 people. You have Paul Graham, who is, often the public face of the group. He's kind of the philosopher king.
He's the essayist, the guy who articulates the vision in these long, thoughtful posts.
Exactly. He sets the intellectual tone. Then you have Robert Tappan Morris and Trevor Blackwell.
And these two are the deep technical heavyweights.
Absolutely. I
Right.
mean, Robert Tappan Morris is a legend in computer science. He's famous, or, maybe infamous, for creating the Morris worm back in the 80s.
Which is basically the first major worm to spread across the internet, so he knows networks inside and out.
He knows them on a fundamental level. And Trevor Blackwell is similarly brilliant, especially in robotics and engineering. So you have this core of deep, deep technical expertise.
But then you have the fourth founder, Jessica Livingston.
Yes.
And I want to pause here and really dig into this for a second, because our source material explicitly mentions that in a lot of the early retellings of YC's history, Jessica's role is often overlooked.
It's true.
People focus on the hackers, the code, the algorithms, but when you look at the facts, overlooking her role seems like just a massive misunderstanding of what YC actually is.
It is a huge oversight. I mean, if you talk to the alumni from those really early days, or if you look at how the organization actually functioned day to day, Jessica Livingston was absolutely pivotal.
In what way?
Well, while Paul Graham was writing these philosophical essays about Lisp and the future of web applications, Jessica was the one handling the day-to-day operations. But it was way more than just logistics.
She was the social engineer?
That's the perfect term for it. She shaped the culture. She was heavily, heavily involved in selecting the founders. And you have to remember, YC isn't just buying a piece of software. The software changes a dozen times.
Right.
They are investing in people, in human beings. And having someone with that high-level intuition for character, for resilience, for group dynamics, that was Jessica's superpower.
So while the guys were looking at the code and the technical feasibility, she was looking at the founding team and asking, are these people going to kill each other in 3 months when the stress hits?
Exactly. Do they have the grit to survive when everything inevitably goes wrong? That social radar was the secret sauce. It's what turned YC from just being an investment fund into a real community.
And you could argue that the reason YC alumni are so willing to help each other today is because of that cultural DNA that she implanted right at the very beginning.
I think that's 100% correct. She set the tone.
Now, speaking of those early batches, the operational model they started with it just sounds exhausting. It wasn't the streamlined, centralized campus we think of today.
Not at all.
They were running a tale of two cities.
It really does sound like a logistical nightmare. Initially, they were running 2 concurrent programs. They had one based in Cambridge, Massachusetts, and one in Mountain View, California.
But they were trying to straddle both coasts. You have the sort of academic, intellectual hub of Harvard and MIT on the East Coast.
Right. The old school tech scene.
And then the burgeoning venture capital heartland on the West Coast. It makes sense on paper, I guess.
It does, but you have to contextualize it. It's 2005. We didn't have Zoom. We didn't have Slack. Remote work as we know it just didn't exist.
True.
If you wanted to manage a cohort of startups and build that culture we were talking about, you had to be in the room with them. So the partners were literally flying back and forth across the country constantly.
They were moving their entire lives twice a year to manage these two different groups.
Yeah, it was incredibly draining. And the source material puts it pretty politely. It just calls it operational complexities.
Which is corporate speak for, this is killing us.
Pretty much. So in January 2009, they made a really critical decision. They closed the Cambridge program for good.
That feels like a watershed moment. It's like they had to choose a home. They had to plant a flag.
They did. And they chose Silicon Valley. They realized that if they wanted this thing to scale, if they wanted the machine to work really efficiently, they had to centralize.
And they had to be where the money was.
More importantly, they realized where the center of gravity was. The venture capital, the big tech companies who might acquire you, the whole ecosystem. It was all clustering in the Bay Area.
It's interesting to think what might have happened if they'd stayed split or if they had chosen Boston. The entire trajectory of the startup world might look really different today.
I think that's true. By consolidating everyone in Mountain View, they created this incredible density of talent. They forced everyone into the same pressure cooker. And that density is what really sparked the network effects that YC is so famous for.
Okay, so let's talk about the fuel for this engine. The money. In the very, very early days, YC was funding these companies essentially out of the founders' own pockets, right?
Yeah, it was very small checks. Almost like a stipend.
But you can't fund 5,000 companies on personal savings. So when did the big money finally enter the picture and validate this whole experiment?
The first major external validation came in 2009. That's when Sequoia Capital led a $2 million investment into Y Combinator itself.
And for anyone who doesn't follow the venture capital scorecard, getting money from Sequoia is a very big deal.
It's the ultimate seal of approval.
They're like the New York Yankees of VC.
Yeah.
They backed Apple, Google, Oracle. If Sequoia invests, everyone else pays attention.
Exactly. And it wasn't just the cash, though. That $2 million allowed YC to start funding about 60 companies a year, which was a big step up. It was the signal it sent to the rest of the market. It said, this weird little accelerator thing, it's legitimate, this is the future.
And then they doubled down pretty quickly after that.
They did. In 2010, just a year later, Sequoia led another round, this time for $8.25 million. This gave YC the firepower to really start scaling the number of companies they could accept into each batch.
But the real game changer, and I remember reading about this when it happened and thinking it had to be a typo, was the Start Fund era in 2011.
Oh, that was a bombshell.
It seemed just too good to be true.
It was. You had the investor Yuri Milner and the firm SV Angel stepping up and making this just unprecedented offer. They said, we will offer every single Y Combinator company a $150,000 convertible note.
Automatically, you get into YC and boom, there's an extra $150,000 in your bank account.
Essentially, yes. No extra pitching, no extra due diligence. If YC said you were good enough to be in the batch, Yuri Milner and SV Angel said, here is $150K.
Wow.
Later on, when the Start Fund was renewed, that amount changed to $80,000, but the precedent was set. It was a fire hose of capital aimed directly at these brand new companies.
That completely shifted the dynamic, didn't it? Before this, startups would go to YC, they'd get a tiny bit of seed money, and then they'd have to spend months begging angel investors for enough cash to survive.
Right, they were always fundraising.
This meant they had real runway from day one.
It industrialized the seed stage. It meant founders could focus entirely on building their product and talking to users for those crucial 3 months, rather than worrying about making rent. It just made YC the single most attractive option in the world for a young founder.
Okay, so that sets the stage perfectly. We have the location settled in Silicon Valley. We have the backing of Sequoia. We have a mechanism to flood these new startups with initial capital. Let's open up the hood and look at the machine itself. How does the program actually work?
The core rhythm of Y Combinator is the batch. Historically, for years, they ran 2 batches a year, a winter batch and a summer batch.
Right.
But what's interesting is that our current source material indicates that they now interview and select for 4 batches per year.
4 batches. That is a significant increase in tempo. It really is becoming a factory line.
It is. So what happens once a company is accepted into a batch? Is it like a university semester?
What's the day-to-day like? Is it like a college semester?
Sort of, but maybe without the grades and with a lot more existential panic. The source describes it as a mix of office hours and weekly meetups.
Office hours sounds very collegiate, very academic.
It does in name, but in practice, it's incredibly intense mentorship. You have these individual meetings with the YC partners, who are often very successful founders themselves.
And they don't pull any punches.
Yeah.
They grill you.
Yeah.
What is your weekly growth rate? Why isn't it higher? How many users did you talk to this week? What is the single biggest blocker to your growth? It's just a relentless, obsessive focus on execution.
And then the weekly meetups are the famous dinners, right? Where they bring in the big guns.
Exactly. Every week, the entire batch gathers. Historically, it was for dinner, and they bring in a guest speaker. And we are talking about the absolute titans of industry. Mark Zuckerberg, the founders of Airbnb, top VCs from Andreessen Horowitz or Sequoia.
And they speak off the record. That's the key. They share the war stories, the unvarnished truths, the secrets of how Silicon Valley really works. It's like downloading the collective wisdom of the Valley directly into the brains of these 22-year-old founders.
And what's the ultimate goal of all this? In those 3 months, what are they trying to get them to achieve?
The source material highlights a few specific goals. First, teaching founders how to market their product. Second, refining their business model. But the most important one, the holy grail, is achieving product market fit.
Which basically means you've built something that a group of people desperately wants.
Right, and you can prove it with data. They want you to have a graph of your key metric that is going up and to the right, because it all leads up to one single high-stakes day.
Demo day.
Demo day.
The graduation ceremony.
But with much, much higher stakes. This is the day where all the startups in the batch present their business and their technology prototypes to a room, or nowadays it's often a Zoom room full of hundreds of potential investors.
And it's designed to create a frenzy, isn't it? It's not a relaxed affair.
It is engineered FOMO, fear of missing out. The entire event is structured to make investors feel like if they don't write a check today on the spot, They are going to miss out on the next Dropbox or the next Airbnb.
It's social proof on a massive scale.
Completely.
So let's get to the brass tacks. If I'm listening to this right now and I have a billion-dollar idea and I decide to apply to YC, if I get in, what is the standard deal? Because I know this has changed a lot over the years, and understanding the money is absolutely crucial.
It is, and the current structure, which was introduced in January of 2022, is quite specific, and it's important to break it down. The headline number they talk about is $500,000.
Okay, $500,000. That is serious seed money. That's not just ramen money. You can hire a team with that. You can build a real product.
For sure, but obviously they aren't just giving it away for free.
Right. What do they take in return?
It's split into two distinct buckets, and this is where it gets really interesting. The first bucket is $125,000.
Okay.
In exchange for that $125K, YC takes 7% equity in your company. And this is done on what's called a post-money safe.
Okay, let's just pause there and do the math for a second. If they're getting 7% for $125,000, that effectively values your brand new, maybe pre-product company at roughly $1.8 million.
Roughly, yes, that's the implied valuation. Now, for some really hot startups coming in, that might feel like a low valuation. They might feel they're giving away too much equity.
So what's the justification?
YC's argument is that the 7% is the price of admission. It's the tax you pay to get into the network, to get that Sequoia seal of approval we talked about, to get access to the alumni database, the advice, the demo day platform.
You're paying for the brand and the network, not just the cash.
Exactly. But that's only the first part. What about the other chunk? That leaves $375,000.
Right. How does that part work?
That is the really fascinating part of the new deal. The remaining $375,000 comes on an uncapped safe with an MFN clause.
Okay, you just dropped a bunch of jargon on us. We need to unpack that. Let's start with MFN. What is that?
Yes. MFN stands for Most Favored Nation. And yeah, it sounds like something from an international trade treaty.
It does. What does it mean for a founder in a hoodie who's just trying to write code?
It's actually a very, very clever mechanism for YC. Simply put, an MFN provision means this. We are giving you this $375,000 now, but we are not going to set a price evaluation on it yet.
Okay.
Instead, we agree that whenever you go out and raise your next round of funding from other investors, we get the same best terms that you give to anyone else in that round.
Can we walk through a concrete example? Because that's still a little abstract.
Sure. Let's say you're a founder. YC gives you that $375,000 on an MFN safety. You go through the 3-month program, you build your product, you get traction.
You get your chart going up and to the right.
Exactly. You get to demo day,
Yeah.
and you find a lead investor. Let's say it's a big firm like Andreessen Horowitz, and they love your company. They say, this is amazing. We will invest at a $10 million valuation cap.
Okay, so that's the deal they offer me.
That's the deal. Because of that MFN clause YC has, their $375,000 automatically converts into shares at that same $10 million valuation cap. They don't have to negotiate.
I see. So YC doesn't have to waste time haggling over the price with hundreds of companies individually right at the beginning.
Precisely.
They just say, take the money, go build something awesome. When you find a professional investor later who does all the hard work of pricing your company, we will just piggyback on whatever deal you negotiate with them.
Exactly. It saves an enormous amount of time and friction. It lets YC operate at scale, and it lets the market decide the fair price later on when the company is more mature.
But isn't there a risk for the founder in that? What if I negotiate a really bad low valuation because I'm desperate for cash?
Well, then YC gets that great deal too. Most favored nation means they get the best deal you give to anyone. So if you give your uncle a sweetheart deal at a super low valuation, YC gets that same deal.
So it keeps the founders honest.
It keeps them honest and incentivizes them to get the best possible terms, which ultimately benefits YC as well. It's an incredibly shrewd and efficient system.
That makes a lot of sense. Now, not every organization that goes through YC is trying to be a billion-dollar unicorn. Some are nonprofits. I was surprised to see that on the list of alumni. How does the deal work for them?
It's obviously very different because a nonprofit doesn't have equity. You can't give away 7% of nothing.
Right.
So if a nonprofit is accepted, and they have accepted some really notable ones like WOTC, the healthcare platform, or Our World in Data, they simply receive a $100,000 donation.
So it's just a grant, basically. No strings attached in terms of ownership.
Exactly. And honestly, for a lot of those nonprofits, getting access to the YC network, learning how to scale an organization, how to pitch donors, how to operate efficiently, is often way more valuable than the cash itself.
So that's the machine as it runs today. It's a factory for success with a very standardized, very clever deal structure. But YC wasn't always just this steady, focused accelerator. There was a period, specifically starting around 2014, where things got, well, they got really expansive.
Yeah, this is the Sam Altman era.
Right. So Paul Graham, the original founder and philosopher king, he stepped back in 2014, and he appoints Sam Altman as the new president. And Sam was an alum himself, right?
He was. He was in the very first YC cohort back in 2005 with his company Looped. So this was a real passing of the torch to the next generation. And under Altman, YC's ambition just seemed to explode.
It really felt like they stopped wanting to be just the world's best accelerator and started wanting to be a global empire that touched everything.
Empire is a good word for it. I mean, look at 2016. The YC partners went on this massive world tour. They visited 11 different countries: Nigeria, Denmark, Russia, India, Israel, Mexico. They were trying to see if they could find brilliant founders anywhere and everywhere on the planet.
And alongside this geographic expansion, they started something called Startup School. This was their attempt to kind of democratize the YC knowledge, right?
Exactly. It was launched in 2017. Startup School was essentially a MOOC, a massive open online course. The idea was, look, YC rejects thousands and thousands of companies every year. Why not try to help them anyway?
So they offered online courses, video lectures, and some level of coaching.
Yep. And in the very first year, more than 1,500 startups graduated from the online program. It was a huge scale.
But speaking of Startup School, we have to talk about the glitch.
Yeah.
This is one of my absolute favorite stories in YC history because it's just so chaotic and so human.
It is the ultimate oops moment in tech. So picture this. It's 2018. A new batch of companies is applying to Startup School. 15,000 startups have submitted applications.
15,000.
They're all sitting at their computers, refreshing their inboxes, just praying for that acceptance email.
You know?
And then, due to a software error, the system sends an acceptance email to all 15,000 of them.
Oh, no. Oh, my God. So you have 15,000 founders all over the world who think they just won the lottery. They're popping champagne. They're calling their parents. Maybe some of them are quit their day jobs on the spot.
Precisely. The celebration is on. And then a few hours later, they get a second email, and it says, actually, so sorry. That was a computer bug. You were rejected.
Ouch. The emotional whiplash there must have been absolutely brutal.
It was. The outcry online was massive. People were furious. They were heartbroken. It was a complete PR disaster for YC.
So how did they handle it? What do you do in that situation?
In a very YC fashion. They didn't just issue a standard corporate apology. They looked at the situation and said, you know what? Let's just do it. They decided to accept all 15,000 companies into the Startup School curriculum.
That's such a bold move. Instead of trying to fix the mistake, they just said, okay, our mistake is now the plan. We're going to own it and just scale the program to fit the mistake.
It really highlights their mindset, doesn't it? Why bother filtering if you can just build software to handle the scale? If the software can teach 15,000 people, then let's just teach 15,000 people. It's an engineer's solution to a human problem.
But not every big experiment in this era worked out so well. There's the big push into China.
Right. This was another major play in 2018. They hired Qi Lu, who was an absolute heavyweight. He was the former CEO of Bing at Microsoft and Baidu in China, a huge name.
And he was brought in to run YC China. The goal was to establish a permanent, on-the-ground foothold in the world's second-largest economy.
It seemed like the logical next step. If you want to be a truly global institution, you have to be in China.
On paper, yes.
Yeah.
But in practice, it just didn't last. By November of 2018, I mean, we're talking less than a year later, YC announced they were pulling the plug. They were not going to pursue the China program.
And Qi Lu departed, and the entity that was supposed to be YC China morphed into a separate, independent accelerator called Miracle Plus.
It just goes to show that even for a powerhouse like Y Combinator, you can't just copy-paste the Silicon Valley culture and playbook into a completely different market environment and expect it to work.
Not at all. The regulatory environment, the funding dynamics, the sheer speed of the Chinese market, it's just a different universe.
Yeah.
And I think it signaled a retreat from the idea of physical international outposts. They decided it was better to bring the world's best founders to Silicon Valley rather than trying to build mini YCs in every country.
Now, running parallel to all this expansion of the core accelerator was a very different and maybe even more ambitious project, something that wasn't about quick returns or 7% equity. Let's talk about YC Research.
This was launched in October of 2015, and it was personally seeded by Sam Altman. He donated $10 million of his own money to get it started.
And the mission was fascinating. What was it?
It was to fund long-term fundamental research. The researchers were paid as full-time employees. This was not about building a product to sell next year. This was about funding moonshots.
And when you look at the projects they actually picked, Moonshot is definitely the right word.
For sure. I mean, the very first project explicitly mentioned in the source material is one that everybody knows today, OpenAI.
Wait. OpenAI, the company that created ChatGPT, the company that is currently defining the entire AI revolution that started as a YC research project.
Yes, it was the very first project undertaken by YC Research. It started as a nonprofit research lab with the goal of ensuring that artificial general intelligence benefits all of humanity.
That's incredible.
Yeah.
I don't think most people know that connection.
It's a huge part of the story. But they didn't stop there. In January of 2016, they announced a massive study on universal basic income, or UBI.
So just giving people free money to see what happens to the economy and society.
Exactly, a real-world experiment. They also had a project dedicated to new cities, which was researching how to design and build better, more efficient, more humane urban environments from the ground up.
And there was one called HNRC, right? The Human Advancement Research Community. The name alone is pretty ambitious.
That one is particularly interesting and maybe a little abstract. The mission statement for HRARC was, ensure human wisdom exceeds human power.
Wow. Okay. What does that mean in practice?
It was inspired by a conversation between Sam Altman and the legendary computer scientist Alan Kay. They brought in other luminaries like Brett Victor. It was really focused on creating new tools for thought, new kinds of modeling, visualization, and programming languages to help humans understand complex systems.
So what happened to HARC? I don't hear about it today.
It was shut down in 2017.
And what about YC research as a whole? Did it continue?
Eventually, it spun out completely. In 2020, YC Research officially disaffiliated from Y Combinator and was renamed Open Research.
So it seems like there was a realization that running a nonprofit blue sky research lab and running a for-profit hypergrowth startup accelerator are two fundamentally different businesses.
I think that's exactly right. They require completely different incentives, different timelines, and just different mindsets. Trying to house them both under one roof is probably too distracting for both sides.
And this brings us to the most recent history, the post-2020 era. And here we see a really distinct shift in strategy. It's a move away from expansion and toward focus.
Yeah, a lot happens in a short period of time. First, obviously, COVID hits the world. The summer 2020 batch goes fully remote for the first time ever.
Which must have completely changed the dynamic of the program. No more in-person dinners in Mountain View. Everything is on screens.
It was a massive change. Then we have another leadership transition. Sam Altman had already left to focus full-time on OpenAI. Jeff Ralston had a tenure as president. And then in January of 2023, Garry Tan takes over as president and CEO.
And Garry Tan is another YC alum. He founded a company called Posterous that was in YC.
He is, and he was also a highly successful VC in his own right with his firm Initialized Capital. And his leadership really marks this period of consolidation. The source material frames it as a return to roots.
So what were the actual signs of this consolidation? What did he change?
Well, one of the first and biggest moves was shutting down YC Continuity.
What was continuity? Exactly.
That was their growth stage fund. It was a separate pot of money designed to keep investing in YC companies as they got bigger in their Series B, Series C, and later rounds.
So they were trying to compete with the big Sand Hill Road VCs.
They were. But in the spring of 2023, they shut it down and laid off the staff associated with it.
So that's a huge statement.
Yeah.
They're basically saying, we are not a growth stage investor anymore. We are an early stage company, period.
Exactly. The thinking was that investing in later stages created weird signaling risks and distracted from their core mission, which is helping companies at the very, very beginning.
What else?
The other big change was the cohort sizing. In the summer of 2022, they deliberately reduced the intake size by 40%. They went from 414 companies in the prior batch down to about 250.
That is a massive cut. Why would they do that?
The source cites the broader economic downturn as one reason, but it also strongly suggests a desire to focus on quality over quantity. If you have over 400 companies in a batch, it's just physically impossible to give them all personal attention. 250 is still a huge number, but it's more manageable.
More hands-on.
A bit more, yes. And then there's the physical move. For years and years, YC was synonymous with Mountain View, down in the South Bay.
Right, the heart of suburban Silicon Valley.
But in the spring of 2023, they moved their headquarters to San Francisco.
Up by the waterfront, right, the Pier 1 area.
Yes. And the source notes they had actually been considering this move since 2019. It's a symbolic shift. The center of gravity for a lot of young founders had shifted from the suburban office parks of Silicon Valley to the city itself. And YC decided to follow the founders.
And we also saw Michael Seibel, who was a really central figure for a long time, stepped down as managing director recently in March of 2024.
Yes, so there was a lot of shuffling in the upper ranks, and all that seems to be pointing in the same direction, a leaner, more focused Y Combinator.
Let's broaden the lens out a bit to the entire ecosystem that YC has built over these years. We listed the giants earlier, Airbnb, Stripe, and so on. But the alumni list is just so incredibly diverse. It's not just consumer apps for your phone.
No, it's really not. You have this whole category of what you could call tech dev tools. These are companies like GitLab, Docker, specifically the part that was Container Linux Heroku, PagerDuty.
These aren't household names for your average person.
No, but they are the essential tools that other developers and other companies use to build their startups. YC essentially funded the infrastructure of the modern web.
And then you have the big international success stories.
Rappi in Latin America is a huge one. It's basically everything app for LATAM food delivery, groceries, payments. And a more recent one is Deal, which helps companies hire and pay people remotely all over the world. These companies prove that the YC model can produce massive unicorns serving markets way outside the US.
And we mentioned the nonprofits earlier, but there are some really fascinating ones in there.
WOTC was the very first nonprofit they funded, and it focuses on healthcare crowdsourcing for people in developing countries. But they also backed an organization called 80,000 Hours, which is a really prominent, effective altruism career advice organization.
And Women Who Code.
Right. It shows a willingness to support organizations that build social capital, not just financial capital, which I think is an important part of their identity.
But not every program they launched survived the test of time. We talked about the Continuity Fund closing, but there was also something called the YC Fellowship, right?
The fellowship is a really interesting case study in their willingness to experiment. It was launched in 2015, and it was aimed at companies that were, believe it or not, too early even for the main YC program.
Too early for YC. Is that just like an idea on a napkin?
Pretty much. A team with an idea, but maybe not even a prototype yet. And initially, the fellowship was equity-free. It was just a grant and some advice.
And then they changed the model.
They did. They shifted to a model where they gave $20,000 for 1.5% equity, but by 2017, they discontinued the whole program.
It seems like they just struggled to find the right economic model for that ultra early stage.
Or perhaps they just realized that the main program was elastic enough to handle those companies if the idea and the team were good enough. You know, why fracture the brand with the YC Lite version?
That makes sense. So as we look back at this entire 20-year history, from a small summer program in Cambridge to this $600 billion value creation engine, what's the big takeaway for you?
I think the story of Y Combinator is really a story of them applying the startup mindset to venture capital itself. They didn't just find a formula in 2005 and stick with it. They iterated constantly.
They pivot, just like the startups they fund.
Exactly. They tried running programs in 2 locations, realized it was inefficient, and they consolidated. They tried expanding to China, realized it wasn't the right fit, and they pulled back. They tried doing late-stage investing with a continuity fund, then decided to refocus on their core competency, which is the early stage.
They're constantly searching for their own product-market fit, even as the market around them changes.
That's a perfect way to put it. And right now, under Garry Tan, that fit seems to be San Francisco-based, intensely focused on the early stage, and much leaner than the sprawling, almost imperial ambition of the Altman years.
It's a fascinating evolution, and it really leaves us with a final provocative thought to chew on. YC Research incubated OpenAI, which is arguably the most important technology company this decade.
Right.
But YC spun that research arm off.
Right.
They also shut down their growth fund. They are consciously and deliberately doubling down on the 2 founders in a garage phase of innovation.
Which raises a really big question. Are we about to see a new golden age of raw early-stage innovation? By clearing away all the distractions of late-stage fund management and global franchising, is YC preparing for the next massive wave of disruption that looks entirely different from the mobile and SaaS wave of the last decade?
Or, here's the flip side. Has the startup industrial complex peaked? Can you really just keep manufacturing unicorns on a schedule year after year? Or was the last decade an anomaly fueled by 0% interest rates and a unique set of technological conditions that won't be repeated?
That is the $600 billion question, isn't it?
Well, if you're out there listening and you think you have the answer, or at least $1 billion idea, you might want to go look up that standard deal we talked about. $500,000 is waiting.
Just make sure you read and understand that MFN clause very carefully.
Always read the fine print. Thanks for listening to this deep dive into Y Combinator. We'll catch you on the next one.
Goodbye, everyone.